Investment is becoming a buzzword for the unsophisticated. Today, everyone's online bank account can be used to trade stocks. There are apps for smartphones. We have more leverage, margin, and debt that can be used to multiply the risks involved. But all of it is concentrated into fewer and fewer corporations. But what could possibly go wrong? You came here for the truth, so let me unveil that for you. Today we're going to look at something that I keep harping on. I keep repeating at the broken record GPS that FAANG stocks account for nearly 100% of the gains in 2018. And that's what we're going to talk about again today. Excluding FAANG stocks, index returns would have been negative. You heard that right. They would have been negative. So all you got to do is extract the FAANG stocks, Facebook, Apple, Amazon, Netflix, Google. Okay, get rid of those and the S&P is in negative territory. Not by much, but it's there. We're looking at negative territory here as opposed to the FAANG stocks contribution to the S&P in the first half of 2018. The second half of 2018 is a big question mark. Nobody really knows what's going to happen this time around because of the weakness, because of the trade issues, and that is a huge concern. Now, this chart here is basically the exact same thing, a little cleaner. You might be able to read it if you're on a small screen. So that will be in the sources as always. This is very concerning to me, and you'll read it here. Tech contributed 98% of the S&P 500's total return in the first half of 2018. Looking at this on the left-hand side, you can see tech. And that is basically, so they're comparing their 2.65 and it's 2.6. So tech represents 98%. You can compare that to the rest. Of course, you have things like staples and financials, which are down significantly. But what I need to understand is why are there only a handful of stocks that represent all of the growth that we are seeing? Why is it that the market, excluding those few stocks, is actually in the negative? Should I be worried? Well, this is what I've been thinking about. If those stocks, let's say, didn't exist, the money would be put into other things. So let's say we didn't have a tech sector, or maybe we didn't have the FAANG stocks. Well, you would find that money would flow somewhere else. Where would that be? Would it be into maybe oil? Would it be into different energy stocks? Would we see it in mining, maybe in financials? Would it be spread around? Or would we see a concentration of wealth regardless? And I think that's really what it comes down to. We see tech this time around. We saw that same thing back in 2000. It doesn't really matter. Ultimately, new bubbles form when previous ones pop. So we saw the tech boom. We saw housing. We saw to a greater degree with commodities going up crazy in such a short period of time. Now we are seeing tech. And there have been other things along the way, of course, but these are the big ones. And that worries me because I have to think all of the markets are interconnected. So whether I look at tech or not, I'm always concerned about how it all connects in with pension funds and everything else. People who are trying to take very little risk end up being exposed to the risk as a result. So this is a very blurry chart, but I'll just cover it quickly. Global non-financial corporate leverage is higher than its peak before the financial crisis. And the reason I bring this up is simply because people are taking on so much leverage today, but they're following along with the investment companies, with the pension funds. They're following along with individuals, traders. They're going in with all of these different ETFs today that are leveraged several fold in order to get more gains. Well, it works the opposite way on the way down. We are talking about people using so much margin to a level that we haven't seen before, and they think it's totally fine. It's a great way to make money. Absolutely. When the stock market's moving up, you could make considerably more money as long as you use your margin. Why not? Why not? And then there's, of course, you can use the shares as collateral to get a loan. Now that is my favorite. When I see that, I have to think we are in the most storybook, fairy tale environment that you would use the shares of a company, which are probably leveraged. Doesn't matter. Either way, these people are taking on the maximum amount of debt, and that's never good. Doesn't matter if it's coming from your house where you put 5% down or 2% down or 1.5% in some cases, or no money down. That's too much. Then we have other cases where we're looking at with the stocks, they're doing it, everything. There's always a way to leverage it. And to some degree, I understand. Look, if you're living in a city where the houses are $1 million, you're not just sitting around with $1 million in the bank. So you have to use some leverage. And that's the way it's been working. That's because of the distortion created by central banks. I get it. I understand. But do you put 5% down? Do you not think that that's going to be a potential risk because of how much debt you carry? Think about your salary today. Think about your household income today. Compare it to what you owe. And if interest rates rise, perhaps they double from today, which historically would be fairly normal. Then wouldn't that become crisis territory for you as an individual? You have to calculate that. Just don't take whatever the bank gives to you. Don't be like people in Toronto. They literally take the maximum. Global stock of debt outstanding. The only reason I mention this, showing you older numbers, but I mention this simply because of this. In this period of time, 2007 to 2014, we have a $57 trillion increase. This is during a time frame where we experienced the boom and bust, okay? Q4 2007, so basically all the growth is over. We decline, and then we have this return all the way up through 2014. The market is coming up for the most part. Everything's just great. But why then do we have so much debt? Because that's how wealth is generated today, with maximum debt. This is how crazy it is. But when we have a crash, it's so, I want to use the same word, it's crazy. Because it comes down so fast, so aggressive, and then every market is interconnected because of all the derivatives. They're all in it, all in the same pool of garbage. It's only worse today. I've shown you the more recent numbers on this. As the population ages, fewer workers will be paying taxes to support each Social Security beneficiary. And you can see this line going down from 1970, and they're predicting up to 2030 how it's going to be. So this is an issue because we've created these safety nets, we've created these social assistance programs, and they are there specifically to help people in need, right? So this is what we've told people: you're going to get that paycheck, have no fear. But when I look to this, I have to understand for myself, how are you ever going to pay all of this off? We're already in debt in the US. They're already in debt, something like $5.5 trillion intragovernmental debt, basically borrowing from the future. You cannot do that. You cannot successfully do that. It's terrible. Nearly half of investment grade companies are rated BBB. So we can see that this has been becoming worse as time goes on. The ratings are coming down, and for good reason, because there is a number one. Let me mention it this way: there is a bigger appetite for risk today than we had a few years ago, because everything apparently is just fine. And you also have the ratings going down because of the risks that are present. So the rating agencies may reduce their ratings. Different countries get brought down, companies get brought down, and so on. But I think there's more to it than that, okay? And then I want to talk about this very quickly at the end. Prudential, everybody's doing it. It's a video that I think it's so important. It's truly important. It's 2 minutes long. If you can watch it for yourself, definitely do. I'll try to just quickly describe what happens. So you see the gentleman in the middle. So he's last to enter the elevator. This is an elevator scene, and they're sort of doing a voiceover as it happens. Everybody is facing the opposite direction. So normally in an elevator, you face the door. So everybody just does that. Now everybody is facing the opposite direction. He walks in and he sees that everybody is facing the opposite direction, so he does the same thing. They showed another example. Everybody in there is wearing a hat. They take off the hat. He takes off his hat too. He puts on the hat. They put on the hat. He follows. So basically, they show you different examples of this. And it is very, very accurate to reality, the herd mentality. You find this with people with body language, how if one person's crossing their arms and they're having a good conversation, suddenly the other person may cross their arms as well. They may develop rapport. If they have a good rapport between each other, then you'll find that maybe that other person starts to do the same thing. They start to build the same laughter and everything. And this is all because people start picking up what's coming off of other people. Now, this is human nature, but when you look at the same way for investments, that's bad. It doesn't and shouldn't work like that. So I'm going to end it there. If you found the video informative, please give me a thumbs up. When you give me a thumbs up, it helps to support the channel. Do appreciate that very much. And if you want the financial education that was not taught to you in schools, it was kept from you on purpose. So I took the liberty of writing these 2 books. In these 2 books, you will learn everything about the foundation, the history, the asset classes, how to make money, tax incentives, and everything else. Definitely check them out. Link is in the description of this video. And if you're more interested in the audiobook version, you can get that at themoneygps.com.